definitely has the elbow room to say that Treasury and FIDC are taking care of the banking crisis and we shall focus on inflation. That possibility still exists, though the market is clearly bending towards a 25% rate hike and one and done. That's where the majority of the market is betting. Is it betting too optimistic? Hemant Mishr, co-founder and CIO at SCUBE Capital and a very well-known face in Indian markets. He was heading Stand Chart in India some time back. Joins us. Hemant, pleasure having you with us after quite a long time. Okay, where do your sympathies veer? Do you think it's possible the Fed goes with 25, but a way more even-handed statement than what the market is expecting?
Morning, Lada. It's a pleasure to be on your show. So our sense is, the job just got a lot more complicated for the Fed. As again, just pursuing price stability, which is what they did until recently. And, only 2 weeks ago when Jerome Powell took the floor, he spoke about wanting to be more hawkish than he has been. Now he's got to do a fine balancing act, price stability vis-a-vis financial stability. And, the former is a marathon. It's a sprint. It's not a problem that can be wished away. Inflation continues to be high. And I'm in Silicon Valley as I speak, right? So I'm getting a pulse of what's happening out here. And it does look like the financial stability problem is something that they can't wish away. As we speak, there are smaller banks that have approached the government and the Treasury for a lifeline in terms of wanting deposit guarantees for the next couple of years or thereabout. So Jerome Powell will need to kind of, in some ways, do a fine balancing act. Talking specifics in terms of rate hikes, I think he can't not act. A 25 basis point is what I think he should do, but not give any guidance. This is not the time to give forward guidances because there's a lot of tightening, credit tightening that's happening as we speak. In some ways, the Fed's job will get done by the banks, because the lending standards will tighten, given a lot of the smaller banks are not seeing deposits coming into them. And if we were to quantify that, the tighter lending standards that will happen on the back of the run that some of the banks have seen, anyway would have meant a hike of anywhere between 50 to 150 basis points. So the Fed is not required to hike much more than the 25 and maybe another 25 later on. But as I mentioned, it's a marathon, it's not a sprint. It makes sense for them to do a 25 and then pause.
Okay. What is your sense about the dot chart? Will not a dot plot also come in the March 22nd meeting? Will the FOMC members want to keep it flat as it was in the previous meeting? And if that is the case, how will the market read it?
So I think they'd want to keep it flat, or they'd want to keep a slightly downward bias, because if they take any guidance from the markets, and they do, and they use the dot plot in some ways to also guide the market. But the markets have in some ways gotten ahead of themselves, talking of 100 basis point rate cut over the next year and thereabouts. So my sense is, as I mentioned, they'll be a lot more dovish than that they have been. They'll continue to talk about inflation being a risk and the Fed having a data-dependent decision-making backdrop. But financial stability is something that will remain paramount, and that would be their immediate concern. So not too much in terms of forward guidance, more in terms of reiterating what Janet Yellen spoke about, wanting to ensure that the system remains stable. An important point, and which is where I think the markets would be focused on, is how will Jerome Powell look at the situation vis-a-vis Christine Lagarde, who last week kind of mentioned that he will look at separate set of tools for financial stability vis-a-vis inflation, and she's continued to focus on inflation. I'd like to think that the Fed and the Fed members will think of it differently. And they do think that monetary policy has a role to play here, because at the end of the day, the Silicon Valley Bank situation and what First Republic is currently going through is caused largely because of liability-related risks and the Fed hiking up rates in a record kind of manner.
Okay, Hemant, like you said, you are at the moment in San Francisco. What is the sense that the money market guys are giving you? Is the crisis period behind, Or do you think that there will be, I mean, who dreamt of SVB, say, 2 months before? Do you think there is still a fear that shadow banks may throw up a problem? Or is this the last of the crisis?
So firstly, they're not shadow banks, by the way, Lata. They are
No,
they
these
banks.
are banks. These are banks.
They're
What I'm
proper
saying is there a fear that, like in the pension guys in UK, is the market fearing that the Fed has taken, the Fed and the FDIC have taken care of the banks, but can there still be problems from other financial quarters?
So that's an excellent question. I think there can be problems, and the UK pension problem is well known. I mean, and the nature of markets, Lata, and you know this because you're such an expert, is the fat tail risks come from a quarter where it's least anticipated. Silicon Valley Bank was seen as the epitome of a new age bank. Took excellent, and they've got a brilliant franchise. They do a wonderful job with the startup ecosystem and their founders, but they did a particularly dismal job of something which is very basic to banking, managing ALM risk. For somebody to set long 10-year duration assets, and that to treasury assets, which are very rate sensitive, is stupid. Even an average CFO won't do that. So there is a banking problem and there is a quasi-banking problem. But I think at this point in time, it's fair to say there's an uneasy calm. So the markets are on tenterhooks. I was there for an investor meeting yesterday, and my sense is people didn't see SVB having contagion across the Atlantic and hitting Credit Suisse, which unfortunately is what happened. So just shows the fragility in the mood of the markets at this point in time. First Republic Bank is a bank which is currently under stress. The stock's down 90-odd%. A bunch of Wall Street banks came in through a lifeline of $30 billion, which is not good enough. I think there are some negotiations happening on getting a liability protection or getting some capital rules waiver so that the bank would get bailed out. So this is not done yet. I think the good thing is the forceful and the decisive action that Janet Yellen is driving is helpful, but it's not done till it's done. So, could you have risk emanate from some of the other banks, smaller banks particularly, and the community banks? Yes, very live. In fact, they made a representation asking for a 2-year guarantee on the deposit. Okay. Now, if something like that happens, I think the contagion gets spread. Contagion gets contained. Otherwise, it spreads.
Okay. Look at it from an Indian investor point of view. Does it all look like, we can say the risk aversion, we are at the moment at kind of, within 5% of the bottom of the markets? Because we are in a sounder position, one would like to think, financially speaking, do you see money returning, FPIs returning to Indian equities?
So we are clearly in a sounder position, and it's not just India, it's a whole of Asia for two reasons. Right? I mean, the Asia, and when I say Asia, I'm saying Asia ex-Japan, ex-China, for two reasons. One is we've not had that steep rate hikes as you've had in the Western Hemisphere, particularly in the US. B is for our banks, the deposit franchise is very retail and as a consequence very sticky, unlike lumpy startup money which could get withdrawn at any point in time. But the second bit also is the duration of the assets. And hats off to our regulators, particularly the Reserve Bank of India, who I have a very high regard for. I remember when I was running Stanchart on the ground, our held to maturity exposure was capped. So when I was digging into Silicon Valley Bank and I saw their held to maturity book was 47% of their book, I said, how on earth can this be allowed? Oh. Because in India you can't do stuff like that unless you had specific approval. So clearly our books are sound, and as a consequence, we will not see credit tightening in India. But the general risk aversion that's going to happen, will that take a toll? Obviously it will. But India and some other pockets, including Indonesia, will continue to be differentiated in what is going to be a new normal. And a lot depends on whether this spreads or it gets contained. But I think the next few weeks are very critical for that.
Okay, then maybe we should touch base after that. For the moment, things will remain in suspended animation and our eyes will be fixed on the statement and the dot plot that will follow the FOMC decision, even if that decision is a given 25 basis. There is so much to read up and understand in the next 12 hours. Hemant Mishr, thank you very much for joining us, and we hope we'll be able to chat with you very soon again. Wrap up on Bazaar on that note of waiting. Chartbusters will take the action forward.